The start to 2023 has seen the winners of the last bull market reemerge after a major downturn in 2022. Chasing recent performance can be tempting as fortunes turn for these strategies, but it wasn't long ago that investors late to the party were left holding the bag when the bubble burst. Today I'm highlighting 3 ETFs whose performance year to date is commendable, but should be viewed with skepticism by investors. These strategies lack long-term merit and carry high fees relative to their top competitors. Managing risk is the name of the game right now, and these ETFs are known for leaning into risk. There are better options that come with more thoughtful, constructed portfolios and lower fees. Long-term investors should pass on these ETFs. The first ETF on my list is neutral-rated Invesco QQQ Trust QQQ. This ETF was among the most popular in recent years, but its fate turned in 2022 as it lost 32.5%. It's popular for a good reason. It's among the top performers in the large growth Morningstar category over the past 10 years. But QQQ misses the mark on the economic rationale behind its portfolio construction. It tracks the NASDAQ 100 index, which was born out of NASDAQ's desire to promote their exchange. It picks the 100 largest non-financial firms listed on NASDAQ and weights them by market cap, arbitrarily excluding stocks listed on other exchanges. Tech stocks make up half of QQQ's portfolio, and it's top-heavy with 54% of its assets in its top 10 holdings. It could be a recipe for disaster to stack companies with shared risk characteristics just because they're listed on the same exchange. The second ETF on my list is negative-rated ARK Innovation ETF, ticker ARKK. Cathie Wood did a great job selling her investing vision, eventually running into capacity problems as her flagship fund gained so many assets. But just as the coffer swelled to the limit, the bubble popped, leading ARKK to drop over 3/4 from its highs. ARKK severely punished investors for chasing returns over the past 2 years. But its high watermark and Cathie Wood's excessive optimism have kept investors' attention. ARK favors companies that are often unprofitable and whose stock prices are highly correlated to one another. The result is a concentrated portfolio of companies that burn through cash and come with extreme valuations and poor profitability. The portfolio currently holds 27 stocks with 64% of its assets in its top 10 holdings. It has become increasingly concentrated as Cathie Wood attempts to right the ship, a fact that belies ARK's poor risk management. Cathie Wood has gone so far as to suggest that risk management lies not with her, but with those who invest in ARK's funds. Buyer beware. The last ETF on my list is neutral-rated First Trust Tactical High Yield ETF, ticker HYLS. This ETF is different from the other two in that it hasn't had periods of staggering outperformance. That's likely an artifact of its 1.27% fee that creates a high hurdle for its managers to overcome. Unsurprisingly, the fund takes on a lot of risk in its attempt to earn back its high fee. This strategy uses borrowing to leverage its portfolio to roughly 105 to 125% of net assets. It also shorts U.S. Treasuries, typically amounting to between 5 to 25% of assets. And this can insulate the fund from interest shocks, but it also introduces risk. This fund adds even more risk by targeting the lower quality segments of the already risky high-yield bond market. This ETF is poised for big losses should market conditions continue to deteriorate, potentially causing interest rates to drop, credit spreads to widen, and default rates to increase. Investors would be wise to look elsewhere for yield.